On Monday, January 12th, 2026, silver punched through a new all-time high. On the futures screens, it has jumped into the mid-$80 range in a single trading session. COMEX volume is surging. Short positions are being taken out in real time. But the surprising part is not the price itself. It is who is setting it. For the first time in modern history, the West is no longer in control of the silver price. The East is. On the surface, it looks like just another wild day in the market. In reality, it is a stress test for a financial system already soaked in debt. A market built on promises is running into the hard limit of real metal. The gap between what the screen says silver is worth and what the world is actually willing to pay is blowing wide open. And that gap does not just matter for banks and traders. It reaches into your savings, your pension, your rent, the real things you hope your money will still buy 10 years from now. So tonight, this move in a dull, gray industrial metal leaves you with a much bigger question. What do you trust more? Paper promises or the rules of scarcity that no central bank can change? And days like this do not appear out of a clear blue sky. For months, the signs were there. Open interest on COMEX climbed while registered inventories fell. Paper contracts multiplied faster than metal in vaults. For months, every sell-off followed the same script. A hard smash and thin overnight trading, then a grind higher. Then came the setup. On Friday, January 9th, the banks knocked silver into the mid-70s in what looked like a clean reversal. Stops hit, margin calls went out, leveraged traders were flushed. The message was simple. The rally is over, silver is going back to 60. But that drop was bait. Every new short around $74 added fuel. From the Sunday evening open, the market never traded normally. Price jumped from roughly 80 to the low 82s with almost no trades in between. That empty strip on the chart is what you see when buyers stop waiting and lift every offer. Through the night, price climbed in a relentless staircase, classic institutional behavior, as big players quietly absorbed every ounce nervous longs sold. The restraint broke around 8 in the morning New York time. A wall of buy orders hit the COMEX book, candles turned vertical, and within minutes, silver blew through 84 and into the mid-$80 zone. The move ended near the high of the day. In chart terms, it was a candle with almost no upper shadow, meaning nobody was really selling at the top. Buyers paid whatever was on the screen just to get in. That is a commercial short squeeze in real time. Banks that sold near 74 are now staring at losses of roughly $10 an ounce. At this scale, that is billions in mark-to-market damage. Clearinghouses see those numbers, raise margin, and close positions by force. So yes, the move is violent, but it is not random. It is what happens when too much leverage sits on too little metal. Yet even that is only the surface. This spike in silver rests on government balance sheets already on fire. Public debt is so high that interest now competes with defense in healthcare. Central bankers still talk about fighting inflation, but for years, rates sat below the real rise in living costs. That gap, negative real rates, is a quiet tax on anyone holding cash or bonds. As the debt load grows, monetary policy slides into fiscal dominance. Central banks stop acting like referees and become a service arm for the Treasury, keeping borrowing costs low even if savers are sacrificed. In that world, it is no surprise that a small monetary metal starts acting like a pressure valve. Silver is not just reacting to a pattern on a chart. It is reacting to years of suppressed yields, swelling debts, and a sense that the currency math no longer adds up. So a caution. Moves like this do not travel in straight lines. When volatility jumps, a $2 or $3 swing in a day is noise. The banks will not surrender quietly. They will try to knock the price back toward the low 80s, the last breakout zone where they hope to trigger late stop losses and shake out emotional buyers. On a chart, it will later look like a simple retest of support. In the moment, if you bought near the top, it feels like the end of the world. In a real supply squeeze, waiting to buy every dip can become a trap. Sometimes the pullback never comes. Sometimes the market goes limit up, trading halts, and you're stuck outside while the new price is set without you. Either way, one level now matters above all, this mid-$80 zone. For big commercial shorts, this is where trading losses blur into solvency risk. Below it, they can pretend the position is manageable. Above it, every dollar higher compounds the damage and drags more forced sellers into the fire. On the chart, the signal is blunt. The ceiling around 80 has gone. The bear trap around 74 has snapped shut on the shorts who chased it. And silver has moved into a phase where the old idea of manageable volatility no longer really applies. To see why this breakout is so dangerous, and not just a passing mania, you have to stop staring at New York and look across the Pacific. While the West is still waking up, Shanghai has already closed. There, the cash price for physical silver finishes almost $8 above New York futures. Real metal into the workshop of the world. In a market that lives on fractions of a cent, an $8 gap on the same metal is a fire alarm. It screams arbitrage. If you run a bullion desk or a big commodity house, the logic is simple. You see bars in Western vaults marked in the mid-80s and buyers in Shanghai paying in the low 90s. You buy in New York, ship east, and sell in China. Even after transport and insurance, there are still dollars of profit per ounce. So the next move is automatic. Any bar not tied up by a contract starts to move. Metal leaves London and New York and heads for Asia. Western banks then face a choice. Let the trade run until stockpiles are gutted and risk admitting they cannot deliver, or push the Western price up until the gap closes, killing the trade, but lifting the headline price. For years, people warned that one day the real-world market, not the futures screen, would set the price. Today, that warning is playing out. China now effectively names it. Their demand is not flexible. China dominates solar panels, batteries, and electronics. Those lines chew through silver. The old habit of running lean stockpiles was smashed by the pandemic and shipping chaos, so manufacturers have shifted to just in case, building buffers instead of trusting the next delivery. If you run a solar plant in Shenzhen and think silver could soon cost $150 an ounce, paying something in the 90s now is not a gamble, it is survival. You're not buying a chart, you're buying the right to keep the factory open. These industrial buyers do not act like leveraged speculators. A 5% dip often makes them buy more because what worries them is not next week's price, it is whether they can get enough metal at all in 6 months. That is what makes this zone so dangerous for the shorts. They are no longer facing jumpy day traders. They are up against factories and state-linked stockpilers who cannot operate without silver. You cannot shake out a buyer who needs metal to keep the lights on, and the industrial side is only half the story. Chinese households see property wobbling and their currency softening. Rules on moving money abroad limit how easily they can diversify. So they do what people in strained monetary systems have always done. They reach for precious metals. When gold starts to look out of reach, they reach for silver. The Shanghai premium is not just an industrial signal, it is also a vote on the currency. Ordinary savers are choosing metal over cash, even when it costs extra. That mix of factories stocking up and households hedging is what pulls the global silver price higher. As long as Shanghai trades well above New York, every attempt to knock the Western price lower only widens the spread and speeds the flow of metal out of Western vaults. If the shorts shove COMEX back toward $82, the gap grows, the reward for shipping bars east gets better, and the cheaper they push the paper, quote, the faster the real ounces walk out the door. This is the corner they are in. Hold the price down and they lose metal. Let the price rise and they lose money. There is no easy way out. We have seen this pattern before in the London gold pool of the late 1960s, in the metal spikes of the late 70s and 1980, and in the silver surge of 2010 and 2011. Each time officials tried to cap a monetary metal, arbitrage and withdrawals drained vaults. The fix calmed markets for a while, and it planted the next crisis. Today, the Shanghai premium and stress on COMEX are the silver chapter of that same story. Paper prices trying to overrule reality and reality pushing back. Now drop down to one person trying to buy an ounce. The news still shows a spot price in the mid-80s, but the street price in the United States is higher. Dealers add $8 or $9 to basic rounds and more to popular coins. So a futures quote a little above 85 turns into a real cost in the mid-90s. Without any change on the screen, what you pay has crept close to Shanghai. The physical market has moved, the quote is lagging. And it is not only about how much, it is about how long. Dealers report delivery times near 8 weeks. That is not a courier mix-up. The private mints that turn 1,000-ounce bars into coins and rounds cannot get enough metal. When a mint says, send the money now, and we will ship in 2 months, they are selling a promise at the retail counter. If that promise rests on metal they do not yet have, you are standing on the edge of a small default. The buffer that usually sits between mines, refiners, mints, and buyers has been sucked up by demand. A senior executive at a major dealer put it bluntly, there is effectively no meaningful silver on the shelf, and if this pace continues, premiums on basic rounds could jump into the $20 or $30 range. At an $85 paper price and a $30 premium, 1 ounce costs around $115. Even if futures were smashed down to 70, a premium of 40 or 50 still leaves the final cost in 3-digit territory. That is, the nightmare for the shorts. They can create contracts and hit the screen, but they cannot create metal. They cannot summon a coin out of nothing. As the gap between futures and street price widens, the casino nature of the paper market is harder to hide. Ordinary buyers watching premiums explode while the official quote lags start to ask a dangerous question. If this benchmark is not telling me what I have to pay, what use is it? As that doubt spreads, behavior shifts. In a normal market, rising prices make people wait. In a shortage, they can do the opposite and trigger a rush. People buy now because they fear that if they wait, there will be nothing left, or that their cash will rot faster than metal rises. That is tight demand. hitting tight supply. Mints cannot add new lines overnight. Miners cannot double output in a year. Refiners cannot process metal they do not receive. We are edging into what you could call the unobtainium phase. At a certain point, the exact number on the chart stops mattering. If a product is out of stock for 12 or 16 weeks or listed as no offer, then for you the real price is effectively infinite. We are not there yet. You can still place an order. But those 8-week delays are a clear signal that the system is strained all the way back toward the mine. The longer those waits stretch, the more the structure starts to look like a slow-motion bank run, not on a branch for paper notes, but on the resource bank, a rush to swap financial claims for real ounces before repricing is done. To see why that pipeline is fragile, follow a single ounce. It starts as ore, is processed into a 1,000-ounce bar, then sent to a vault in London or New York, where it may be pledged, lent, swapped, or used as collateral for more than one claim. Later, a bar is taken out, either to feed an industrial buyer in Asia or to be cut up by a mint and struck into coins and rounds. Every step in that chain has limits. Mine output, refining capacity, mint presses, finished stock. If any link does not get enough metal, the chain slows. An 8-week delay at the end is not just a busy driver, it is a warning that somewhere upstream ounces are not flowing. And this is not a field where you can throw a switch and flood the market with supply. Most silver is produced as a byproduct of mining for copper, lead, zinc, or gold. If demand for those base metals slows, silver output can fall, even if the price is screaming higher. Dedicated silver mines exist, but they come with long lead times, strict permits, and heavy upfront spending. For years, many miners scraped by at prices that barely covered costs. They did not rush to build new projects because the paper market signaled that silver was cheap and unremarkable. Now the bill for that lack of investment is arriving at the worst moment. Put these three pieces together, the breakout on the chart, the east versus west price gap, and the dealer shortages and weak supply chain, and it is very hard to call this a normal session. This is not a quirky trading day, it is a failure of price discovery. Silver has spiked before, especially in the late 1970s and around 1980, but the backdrop now is different. Debt is heavier, supply lines are more fragile, and silver sits much deeper inside energy and technology. So where could this go? Is $85 the top? Is the Shanghai print in the 90s the ceiling? Or is $100 just the next stop? To even start to answer that, you have to stop treating the dollar as a solid ruler. When the ruler itself is stretching, measuring the bridge tells you more about the ruler than the bridge. Instead of staring at price in dollars, think in ratios, especially the link between gold and silver. For centuries, from Rome through formal gold and silver standards and into the early United States, the rough natural ratio sat around 15-1. In the modern paper era, that link was bent out of shape. Financial engineering pushed the gold-silver ratio to 80, 90, even 100-1. Silver was treated as cheap industrial scrap, not as money. Now that distortion is shrinking. With gold in the mid $4,600 zone and silver in the mid-80s, the ratio has slid into the mid-50s-1, still far from 15-1, but moving that way. Run a quick thought experiment. If gold stayed where it is and silver moved back towards something like 15-1, it would not sit at $80, it would be somewhere north of $300 an ounce. Seen that way, this looks less like a final top and more like the early stages of a catch-up, a re-rating that shifts silver from industrial leftover back toward a monetary asset. That is why many seasoned watchers do not see $100 as fantasy, but as a nearby psychological line. Shanghai is already in the low to mid-90s, once you convert the price, and American street prices with premiums are close. The laggard is the futures quote on COMEX. When silver finally shows a 3-digit spot price on that screen for the first time, it will not just be another quote, it will be a television headline, a full-page chart in big newspapers, a trending topic online, the moment of maximum noise and maximum risk. Before talking about what to do in that kind of storm, it is worth asking a harder question. What could break this thesis? No move is guaranteed. A global recession deep. Enough to hit demand for solar, electronics, and batteries could take heat out of this squeeze. Policymakers could choose real pain now, holding interest rates high enough, for long enough, to give savers positive returns on cash and bonds. New technology could steadily trim how much silver each unit of output needs, easing long-run demand. None of those paths are painless, and all of them have costs. But setting them out matters, because it marks the line between analysis and cheerleading. If you know what would have to change to turn this from a deep reset in pricing into a brief spike, you're less likely to be blindsided whichever way it breaks. So who wins and who loses if this keeps going? On the winning side are people who already hold physical silver without much debt and sat through the boring years, plus industrial users that locked in supply and miners with low-cost reserves, whose ounces suddenly matter again. On the losing side are over-leveraged shorts who used silver as cheap funding and are now stuck in a margin nightmare. Savers trapped in weak currencies and low-yield bonds as their spending power fades, and late buyers who chase spikes with borrowed money and panic sell every slam. Most people fall into one of those groups, and you want to know which before the swings decide for you. That leads to a harder question. Not how high, but then what? If you already hold silver, you have probably done the math. At 85, at 100, at some higher number, the pull is strong. I could sell, clear the mortgage, buy the car. Before you act, ask what you are really trading. You would be giving up a finite asset, being marked up by monetary stress, and taking back the paper claims that stress is eroding. In every major currency breakdown from Weimar to Zimbabwe and Venezuela, people sold metal early for piles of cash that soon bought almost nothing. That does not mean never sell. It means the exit matters more than the target. Think in ounces into other assets, not ounces into cash. You do not sell just because the screen looks high. You sell when you can turn part of your stack into real income-producing assets that have become cheap in comparison: land, good businesses, property that pays rent. Today, it might take several thousand ounces to buy an average home. In a silver mania during a credit crunch, that could drop to hundreds. Shifts like that are where wealth changes hands, while the headlines shout about bubbles. This is not personal financial advice. It is a way to think about price and value when you no longer trust the unit you measure with. So where does that leave us? The charts say a new phase has started. The gap between Shanghai and New York shows demand in the east pulling the price up, and the big premiums and long waits at dealers tell you the chain from mine to mint is under strain. The banks will not walk away. So expect talk of new rules, quiet meetings, and sharp slams in price aimed at shaking out nervous holders. Expect the swings to feel sickening, but watch the deeper signals. Does the Shanghai premium vanish? Do dealer weights shrink? Do stocks at COMEX and in the big vaults rebuild? If the answer stays no, this is not played out, because this is bigger than one metal. We are sliding away from a world built on ever-growing piles of debt toward one where control of real things, energy, food, key metals becomes the final collateral. Countries that mine silver, like Mexico and Peru, are already asking how much to keep, and countries that need it, like the United States and China, are quietly competing to lock in supply. You sit in the middle of that. Tug of war every time you choose between holding promises and holding something that exists in the world. In the end, charts tell one story and your day-to-day buying power tells another. So the real question is not what is the price of silver, it is what you trust more. The money printed by governments or the limits of scarcity that no government can change. Think about that before you sell the last ounce you have. Thank you for watching. And please subscribe and like the video. Nothing in this documentary is financial advice. Always do your own research and consult a licensed professional before making financial decisions.